Let's talk to Gaurav Sharma. He's an oil market analyst and, according to my ledger, a Forbes columnist.
Good to be back.
Very good morning to you, young Gaurav. Right, oil is your specialised subject. British Petroleum, BP, reported this morning. I saw big headlines yesterday. They bought back into the US in shale in a massive way. How were the numbers?
Oh, we always like these crude mornings, don't we?
We do.
And BP has set us off for a good start. Now, essentially, this is big news because, for starters, over the weekend, they sort of revealed, or rather on Friday, they revealed that they'll re-enter sort of the US market in a big way. So what happens is that they divest in Alaska and then go for BHP Billiton's old assets. Now, if you recollect, BHP Billiton bought these for $20 billion back in 2011 at the height of the market froth. We were just returning from the financial crisis, and BHP Billiton thought, well, let's have a slice of that. Massively overpaid, couldn't do much with it because they really didn't have much pedigree in the business. So lo and behold, BP comes along, buys them up for about $10.5 billion,
Yep.
fighting off, according to my sources in Houston, fighting off another 50 oil companies after the same assets, and in particular Chevron was really keen on them. So it's a big coup for them, more especially because they've got about 40,000 barrels equivalent for oil per day production in the Permian, which is one of the most sort of profitable basins there. It's sort of, you could probably make money quite handsomely because it's $22 a barrel in terms of break even. So that's there. But the other key thing is the impact statement, and that ties into their quarterlies this morning. First of all, they make this impact statement that they're back in business. They've made their big it's their first big ticket purchase since 1999, predating Macondo and all the rest of it. So there's that bit, and then of course there's a share buyback program that is associated, which on Friday didn't please the city all that much and Wall Street all that much. So there was a little bit of a dip in the price. But in order to sort of get the shareholders on board, they've given a bit of a sweetener, and everybody loves that kind of news in the morning.
Dividend.
Hike the dividend. So they've taken that up by, and let me read that out. So it's 10.25p. So that is their first dividend increase since 2014. And now look at the second quarter profit. A mixed bag of upstream and downstream, but they're primarily attributing it to upstream, and their quarterly reported is $2.8 billion, which is 4 times the same profit they logged on an annualized basis of the same quarter in 2017. So that gives me room for optimism. Now, if you look at the two blue chips, you look at Shell and BP, on BP, I personally would have a buy recommendation. And if you recollect, back on this very program in February, we were at, BP was about 430-ish, and then the results came out.
Yep.
And my target at that point in time was 550, but of course it declined. And a lot of people said, really? Or are you going for 550? Now, not only has it beaten that 550 target to about 570 right now, touching 570, I think right here on Go Finance TV, I suggest my new target is 650. And that's not primarily down to what they're doing upstream, Moose. I mean, if you look across the board, they're doing lots of things. First of all, they've started re-entering the retail market with a play in Mexico. And these gas stations they want in Mexico, they're also putting electric charge points. So they are responding to different consumer tastes in terms of fuel retail. They're managing their upstream portfolio quite frugally. They were according by Rystad Energy, they said that BP and Shell are actually among the two majors whose lifting costs are really optimized. So I think that gives room for a reason to sort of think that the prices onwards and upwards, and today's figures vindicate that. Now, in terms of Shell, I'd say a holding pattern, because let's face it, Shell shares do cost a bob and arm and a leg if you really want to go do a straight comparison between 100 shares BP and 100 shares Shell. Whereas RDSA, if you want to pay a fee to the Dutch taxman, then you go for the A shares, which are slightly cheaper, and the B shares slightly higher. But nonetheless, 100 shares will set you back by £2,700. So with Shell, you've got it on your portfolio, hold it. It's never disappointed since the Second World War, always pays dividend. As for BP, in the current oil price climate, I think if it can make its new plays work and optimize its upstream operations, as it's been saying, then I think it's in a very good place. That brings us to the oil price, of course. Can't avoid that particular discussion. Now, it's a little bit elevated at the moment because obviously we've had this kerfuffle where the Saudis have said that their tankers are at risk along the Yemeni coastline. So that's keeping the price a little bit up. But each time the benchmarks try to break free, West Texas is at 70, Brent is at 74 before we sort of came on. Each time they try to break free, there is a corrective mechanism. And that corrective mechanism explains BP's shale play, because these shale plays are doing well. Forget BP. BP would be looking at 190,000 barrels per day, barrels of oil per day equivalent. But some of these shale plays, they're making 5,000 barrels per day, 15,000, 20,000, and they're making it work at $40. Now, if BP goes for a play that makes it work at $22, then you're really onto something. The oil price is kind of stuck. I think each time it tries to break free, there's a corrective mechanism. People look at the US rig counts, the rig counts go up, and then again, the buck or two that it gains, it comes straight down. I want to have a play on the market. I think the average price for my average price, I maintain that as I have all along in this program. For Brent, my average price is about $70. West Texas, $65 for all of 2018. Coming weeks and months, keep an eye on what Aramco does, and if there is further kerfuffle, then you can keep having a 100-point spread, 200-point spread either ways.
On that note, Gaurav, thank you very much indeed.
Good to be back.